There is a deep current running through the financial world today, a river of good intentions and noble aspirations that promises to heal the earth even as it fills our coffers. This current is known as ESG investing, and it has surged to become an almost unquestioned force, often presented as a dual triumph for both ethics and returns. We are constantly told it is the path forward, a way to align our deepest values with our financial ambitions. Yet, for the critical investor, for those of us who feel the quiet unease beneath the surface of popular narratives, this pervasive, feel-good story can sometimes feel like a gentle lullaby designed to soothe us into overlooking the rigorous financial scrutiny every investment demands. Does your heart ever ache with the sense of being swept along, unsure if the path you walk is truly solid ground or merely a shimmering mirage? Do you sometimes feel overwhelmed by the sheer volume of conflicting information, longing for clarity that cuts through the noise? Today, we must ask the challenging question: what are the deep, hidden financial risks and systemic vulnerabilities that lie beneath this widely accepted ethical veneer? We are not here to dismiss the importance of a better world, but to uncover the genuine underlying mechanisms, the hidden truths, and the effective strategies of complex financial markets, distinguishing them from common misconceptions and superficial analysis. Benjamin Graham, the very soul of intelligent investing, taught us to build a margin of safety by understanding a company's intrinsic value, not just its fleeting market price. He urged us to look beyond the headlines, to dig deep into the verifiable data, to seek the truth that resides within the numbers. We must apply this same unwavering rigor to investment themes like ESG, questioning what truly underpins the popular sentiment versus what is genuinely valuable and secure. Don't just invest, understand the why behind every decision. We are uncovering the hidden truths behind wealth accumulation. This space is for those who dare to question, who seek not just returns, but understanding. It is for those who wish to move beyond the superficial labels and marketing, to truly grasp the intrinsic value and the sustainable wealth creation that comes from informed, data-driven decision-making. Are we truly seeing the full picture, or are we allowing good intentions to blind us to potential dangers? Have you ever felt that quiet, gnawing anxiety, a whisper in your heart that perhaps the grand promises of sustainable investing might be too good to be true? There's a silent fear many of us carry, the dread of being misled by corporate greenwashing, by superficial sustainability claims that ultimately fail both our ethical compass and our financial performance. This feeling can sow a deep distrust of financial authority, making us question the very narratives we are told to believe. The common distortion we encounter is the idea that a high ESG score universally guarantees a genuinely sustainable company or superior financial returns. This belief, however, often masks a troubling lack of transparent, standardized metrics and verifiable impact data. It's like being told a book is profound simply because its cover is beautiful, without ever reading a single page. How often do we let the packaging define the product? The shattered expectation comes when we discover that many high ESG-rated companies may still harbor significant, hidden negative environmental or social impacts. These truths are often revealed only by meticulous, forensic analysis, by deconstructing their entire value chain and scrutinizing their capital allocation decisions. This challenges the very ethical facade they present, leaving us to wonder if we've been investing in impact or just marketing. To truly look beyond the headlines, to understand what's really driving the market, we can employ a disciplined, three-step forensic accounting technique rooted in value investing principles to dissect these ESG reports. First, verify capital expenditure on sustainable initiatives. Are they truly investing in change or merely making pledges? Second, cross-reference self-reported data with independent environmental and social audits. Does the company's story align with external reality? Third, analyze lobbying efforts and regulatory compliance records to expose potential regulatory arbitrage. Does their public stance match their political actions? The ESG score, in many ways, can be a beautifully designed corporate facade, much like a polished annual report that conceals underlying financial weaknesses. A critical investor, akin to Benjamin Graham, must look beyond this glossy exterior to the true structural integrity of the business, its verifiable impact and financial resilience. We are uncovering the hidden truths behind wealth accumulation, because true value is never found on the surface. Have you ever felt that quiet, gnawing doubt, a subtle whisper that perhaps, in our earnest pursuit of ethical investments, we might inadvertently be imposing an unseen opportunity cost on ourselves? This feeling can lead to a fear of financial inadequacy, a worrying that our well-intentioned choices might be causing underperformance due to unexamined portfolio exclusions and hidden sector biases. It's like tending a garden with blinders on, nurturing certain plants while unknowingly neglecting others that could bring forth abundant fruit. There's a pervasive myth, often propagated by marketing, that ESG investments inherently provide provide an ethical alpha or superior risk-adjusted returns simply by virtue of their ESG credentials. This narrative can conflate correlation with causation, leading us to believe that doing good automatically translates to doing better financially. But the truth, as Warren Buffett often reminds us, is found in the numbers, not just the narratives. Is your diversified portfolio truly diversified, or are you narrowing your field of vision? The counterintuitive truth, revealed by rigorous quantitative analysis and historical market context, is that any perceived ESG outperformance is frequently cyclical, often concentrated in specific sectors like technology, or a transient result of particular factor exposures. It's rarely an intrinsic, persistent ESG benefit that endures through all market conditions. This isn't to diminish the value of responsible investing, but to demystify the claims and ground our expectations in data. To navigate this complexity, we need a strategic framework, drawing from modern portfolio theory and behavioral finance to quantify the potential opportunity cost of ESG exclusions. This framework helps us integrate ESG considerations thoughtfully, without sacrificing true diversification or optimized risk-adjusted returns, empowering us with independent decision-making. It means asking, what am I truly giving up? And is that sacrifice justified by verifiable impact, not just a label? The search for ethical alpha in ESG can sometimes feel like chasing a phantom dividend. It's an appealing, morally gratifying promise that often dissolves under rigorous financial scrutiny, leaving behind the real, measurable returns that were foregone due to unconscious cognitive biases like confirmation bias and emotional attachment. We must challenge the consensus, find our edge, and let data-driven truth be our guide. Have you ever felt that unsettling anxiety, the quiet worrying that in our collective pursuit of doing good through ESG investing, especially via popular funds, we might inadvertently be exposing our carefully built portfolios to unforeseen systemic risks and dangerous concentration biases? It's a feeling that echoes the unsettling pitfalls of past market bubbles, fostering a deep distrust of conventional wisdom that tells us everything is fine. This feeling, this doubt, is a sign of a critical mind at work. There's a common distortion that ESG funds are inherently diversified and risk-mitigated simply because of their responsible selection criteria. This belief can lead investors to overlook the underlying homogeneity that exists within many ESG portfolios. It's like believing a forest is diverse simply because all its trees are green, without realizing they are all the same species, vulnerable to the same blight. The hidden truth, often obscured by the ESG narrative, is that many popular ESG indices and funds exhibit significant sector concentration, frequently leaning heavily into technology, renewable energy, or specific growth-oriented industries. This inadvertently creates an echo chamber, a clustering of capital that becomes highly vulnerable to specific market rotations, interest rate changes, or sudden regulatory shifts. This systemic risk is often overlooked by mainstream analysis, a blind spot in the pursuit of perceived virtue. What if interest rates stay high? Are you prepared for such a rethinking? Inspired by Ray Dalio's principles of diversification across uncorrelated assets and understanding the resilience of all-weather portfolios, we can engage in a critical thinking exercise. Dissect ESG fund holdings for hidden concentrations, identify single point of failure risks, and scrutinize genuine diversification metrics that go far beyond simple sector labels. Don't just accept the label, truly understand the underlying composition. Investing solely in a popular ESG fund without critical analysis of its underlying holdings is akin to building a house entirely from eco-friendly materials, only to discover they all come from the same vulnerable supplier. The perceived strength is an illusion, exposing the entire structure to an unacknowledged systemic risk. This is a crucial lesson in capital allocation, often forgotten in the rush to embrace popular trends. Challenge the consensus, find your edge, and seek true resilience. Have you ever felt that underlying apprehension, a quiet unease that the rapidly evolving, often ambiguous, and regionally disparate nature of ESG regulations could lead to unforeseen investment landmines? It's a feeling that this complex, shifting landscape might create an uneven playing field, one that benefits the well-connected and leaves others navigating with a sense of inadequacy in a world of ever-changing financial rules. This feeling is not unfounded, for the ground beneath our feet is indeed moving. There's a common distortion that ESG definitions are stable, universally agreed upon, and provide a consistent, reliable framework for long-term investment decisions. We are often led to believe that these guidelines are set in stone, a clear path forward. But this perception often ignores the powerful political and lobbying forces constantly shaping and reshaping these very definitions, making them less a fixed star and more a flickering candle in the wind. The counterintuitive truth is that this very lack of standardized global ESG metrics creates fertile ground for regulatory arbitrage. It allows companies to subtly game the system, leading to misleading classifications, short-term compliance plays, and potent investment traps for the uncritical investor. It's like watching a river reroute itself, creating new eddies and currents where dangers can hide, all while the surface appears calm. What's really driving the market when the rules themselves are in flux? To navigate these treacherous waters, we need a comparative analysis framework, drawing from economic theories of market efficiency and information asymmetry. This framework helps us identify companies that genuinely integrate sustainability into their intrinsic value versus those merely adapting to minimum regulatory requirements or engaging in ESG window dressing. It's about looking beyond the stated intention to the verifiable action, to the true commitment etched into their capital allocation and operational DNA. Navigating the ESG regulatory landscape is like investing based on a map where the cardinal directions constantly shift. Without a critical compass of intrinsic value, long-term economic moats, and true impact, investors are susceptible to being led astray by short-term compliance plays and regulatory fads, missing the true north of sustainable wealth creation. Don't just invest, understand the why behind every decision. Challenge the consensus. Find your edge. There's an unacknowledged fear that often whispers in the quiet corners of our minds. What if our deepest desire to do good, to conform to the noble social norms of our time, is unconsciously overriding our sound financial judgment in ESG investing? This feeling, this internal conflict, can lead to an emotional attachment to investments that may not serve our long-term goals, leaving us with a wounded financial confidence. It's a pain born from the clash between our values and the harsh realities of the market. We often cling to the myth that our investment decisions are purely rational, especially when noble causes like ESG are involved. But this common distortion ignores the profound, almost invisible influence of our behavioral biases, those subtle currents that pull us off course without us even realizing. We are not machines, but beings of emotion and aspiration, and these factors are powerful forces in our financial lives. The hidden truth, illuminated by the work of thinkers like Daniel Kahneman, is that cognitive biases like moral credentialing, confirmation bias, and the bandwagon effect are particularly potent in the ESG realm. These biases can lead investors to selectively focus on positive ESG narratives, like a warm blanket on a cold night, while unconsciously overlooking critical red flags or negative financial implications in companies we deem ethical. We see what we wish to see, rather than what truly is. To truly heal and strengthen our financial confidence, we can embrace a mental healing model inspired by Kahneman's profound insights into System 1 versus System 2 thinking. This model is designed to help us identify and mitigate the emotional and cognitive traps specific to ESG investing, fostering a more disciplined, data-driven, and truly independent approach. It's about building an inner fortress of critical thought, protecting ourselves from the market's psychological currents. The allure of virtue signaling in ESG investing is like a psychological siren song. It promises moral satisfaction and social affirmation, a feeling of belonging. Yet, without the unwavering anchor of rigorous financial analysis, critical thinking, and a profound awareness of one's own behavioral biases, this siren song can lure even the most well-intentioned investors onto the treacherous rocks of underperformance and regret. It undermines our ability to connect complex financial theory to practical, profitable application to truly build sustainable wealth. Don't just invest, understand the why behind every decision. We have journeyed together through the intricate landscape of ESG investing, peeling back the layers of popular narrative to uncover the deeper currents beneath. We have gently yet firmly confronted the illusion of ESG scores, questioning whether we are truly investing in verifiable impact or merely in marketing. We have explored the myth of guaranteed ethical alpha, recognizing that superior returns are rarely a given, but rather a product of diligent analysis and market conditions. We then looked into the systemic dangers of ESG concentration, understanding how even good intentions can lead to unforeseen vulnerabilities. And finally, we examined the traps set by regulatory ambiguity, where a shifting landscape can create arbitrage opportunities that ensnare the uncritical investor. In this journey, we have seen that the profound power of a skeptical, data-driven mindset is truly the ultimate shield against market hype. It is the compass that guides us through the fog of sentiment and the key to unlocking genuine financial mastery, not just in ESG, but in any investment landscape that beckons us forward. Does your heart feel a little lighter now, knowing that clarity is within reach? Sustainable wealth accumulation, the kind that truly endures and compounds, stems not from blind adherence to popular narratives or well-intentioned but flawed investment trends. No, it blossoms from unwavering critical analysis, from a deep and abiding intimacy with intrinsic value assessment. It demands that we look beyond the surface, beyond the labels, and into the very soul of a company and its true economic reality. Therefore, let this be our mandate. mandate to demand absolute transparency from every investment, to apply rigorous due diligence to every single decision, and to cultivate an independent, questioning mind for all financial endeavors, including those adorned with the ESG label. It is a sacred practice, a commitment to truth that liberates us from the anxiety of the unknown. Benjamin Graham, with the wisdom of ages in his voice, famously stated that an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. This foundational principle must be our guiding star for ESG, ensuring our good intentions are rigorously backed by verifiable data and sound financial logic, not just market sentiment or fleeting moral conviction. Are you ready to reclaim your investment autonomy, to become the truly critical investor you were always meant to be?